Friends, welcome to the channel JAIIB and CAIIB Made Simple. In this particular video, we are going to quickly revise our module C of IIBF AML KYC syllabus, that is the Know Your Customer. So friends, let's get started. Have you ever wondered how bank really know you and why that matter? So first of all, KYC stands for Know Your Customer. It means the bank must check who you are before doing important things. As bank grew and people use check and other paper promises which are called negotiable instrument, so bank needed to be sure that the person on the paper was real. Negotiable instrument are the things like check, promissory note that can be passed from one person to the another. Now, long ago, bank often relied on introduction. Someone who already had a good relationship with the bank would vouch for a new customer. Think of it like a friend recommending you to a landlord. The bank trusted the introducer word. Now, the third foundation of trust, the introduction became the foundation of the banker customer relationship. It helped the bank decide whether to accept deposit or lend money to that person. Right. Over the time, this trust based practice evolved into formal check, that is document, identity proof, and other verification, what we now call KYC. Now if we talk about account access, an introduction was not always mandatory, but it helped. Without an introduction, the bank might still open an account but limit services. So introduction unlock fuller banking service. Now friends, when bank lend money, they want trustworthy borrower. Right, trustworthy here means things like steady income, good reputation, past repayment history, or collateral. So dealing only with trustworthy borrower keep the bank's losses low. This is called risk management. Now friends, because bank preferred borrower with a good track record, so borrower were often more disciplined about repaying. That discipline reduced the bank credit risk and the chance that the borrower won't repay. So to summarize, bank moved from simple introduction, someone vouching for you, to a more formal process of checking who you are. Now friends, let's look at introduction of the CDD. So have you ever heard of CDD? It sounds technical, but it's just bank way of checking who you are. CDD means customer due diligence, the check a bank does to identify, verify, and understand a customer and the reason they want to bank with them. Think of it like the background check before giving someone a bigger responsibility. Why was CDD introduced? The need for CDD was that as a proactive step, not waiting for problem but looking for them early. From credit risk to a wider risk. At first, bank checked customer mainly to decide whether to lend money. Over the time, the same check were used to fight money laundering, terrorist financing, and fraud. Money laundering means hiding illegal money to make it look illegal, and terrorist financing means giving money or legal or illegally to fund terrorism. If you look at the dual role of CDD, so CDD does two big jobs at once. First of all, it helps bank judge whether someone can repay a loan, and second, it protects the bank and the system from criminal. Now, if we talk about how CDD become a universe, so you can see CDD stopped being only for borrower. It is now applied to all types of customer. If you look at the global push, so you can see that women basically it worries about the money laundering after big international crime and drug market. If you look at the key milestone, after the late 1980s, global concern grew. FATF was set up in the 1990s, right? It put it important rule, the famous 40 recommendation, and BCBS guidance in 2001, right? So the Basel Committee on Banking Supervision issued a detailed guideline to help banker strengthen the CDD worldwide. That's called customer due diligence worldwide strengthening. Now there is something called KYC rigors. So before that, what bank do under this CDD? Let's look at. So first of all, they identify the customer, right? So they identify the customer first, who the customer really are, right? Then under CDD, what they do, they verify, they understand, they monitor, bank enhance the credit risk. So now let's talk about purpose of KYC rigor. Why do bank ask so many questions before opening an account? So KYC means know your customer. The rules and the check called KYC rigor are there for three simple reasons. Customer identification, which means bank spot risky people early. So bank check identity to find and spot people who might misuse the account, like fraudster or criminals. So friends, customer identification means spot risky people early, right? Then protection of the interest, which means for both bank and customer. KYC stop misuse that could harm the bank or honest customer. Secure operation, which means keeping bank transparent and safe. Good KYC keep transaction clean and trustworthy. So everyone from a shopkeeper to a big company can rely on the banking system. Now the question is, why a formal KYC policy is essential? So KYC is not just a one-time check. Bank must have a documented policy that everyone follow. Why? Because of PMLA compliance. So in many countries, Indian bank must follow the law like the Prevention of Money Laundering Act. This law requires the strict KYC and record keeping. For example, if the bank does not follow the law, it can face big fine and legal trouble. KYC is not just for one team. It must work across the whole bank, front desk, loan, online services, compliance team. You can think of it like a safety routine. Everyone in the bank must practice the KYC at the same way. Then, regulators like the Reserve Bank of India tell bank to design KYC policy that match their product and processes. Right. So RBI to bank, bank to KYC policy flowchart. Then board approval. So a bank board of director must approve the KYC policy. This sort KYC is important at the highest level, not just paperwork. Like bank board approval means the bank take KYC seriously and give it the resource it needed. So KYC record help spot risky people, protect everyone, and keep banking safe. A clear KYC policy backed by law, applied across the bank, and approved by the board make this reliable and effective. Now, friends, let's talk about bank don't set KYC rule and forget them. They keep changing them to stay one step ahead of the criminals. So I will explain how that happen and what bank must do in plain English. First thing is global dynamism. KYC and AML CFT rule are updated continuously around the world. So countries and bank can respond to new tricks used by money launderers and terrorists. So you can think of it like an antivirus update for your phone. The rules get smarter over the time. Second point is RBI updated KYC AML guidance by looking at both the global standard, right, what group like FATF recommend, and the India's own risk, such as how criminal or terrorist financier operate locally. So when FATF or other international bodies changes a recommendation, right, or when new local risk appear, RBI issues or update direction and frequently asked question. So bank follow the right step. What about the legal alignment? So government update law like the Prevention of Money Laundering Act and its rule so that they match the international best practices and make enforcement stronger. There is something called regular policy review. Apart from the policy, bank also update customer record periodically, depending on the consumer risk or customer risk. High risk customer are updated more often. Low risk customer are updated less often. Now, what is CAP? It is the bank written rule book that says who the bank will accept as a customer and who it will not. CAP protect the bank from unknowingly onboarding risky or fake customer. CAP includes clear do's and don'ts. For example, no anonymous participants, criteria for high risk and low risk, and a step to handle customer who cannot be verified. Right. So that is about CAP. That is called CAP, customer identification procedure, acceptance policy. So friends, summing up, global rule changes, RBI watches and update guidance for India, law get aligned, and bank must review their KYC policy regularly, right? And one essential piece of that policy is the customer acceptance policy, the bank checklist for who it will onboard. Now let's look at the key elements of KYC policy. Want to know what make a bank KYC policy strong? So I will explain. Customer identification procedure, or we call it CIP, are the bank first check to know who you are before any relationship start. So it means that it collect ID like Aadhaar, password, address, proof, information about who really on the account. Why it matters? Because it build a complete profile so that bank know if the person is real and what kind of banking they will do. So for example, if suppose someone open a business account, so CIP help the bank know who run that business and who benefit from the money. Second is transaction monitoring. What does it mean? So it means that transaction monitoring means watching account actively continuously to spot anything changing. Like bank set rule, they like alerts if a small account suddenly get huge cash deposit. So the purpose is to find unusual or suspicious transaction early so that action can be taken. And what about the example I told you? If a student account suddenly receive large business payment, monitoring will flag it for review. Then we have the risk management. Risk management is the system bank use to decide how careful they must be with its customer. So you assess the customer risk, you score or categorize them, and you apply the control. This is the step that is followed. So control includes what? Control includes normal check for low risk, extra check for high risk, right? We have an example. Now then we have comprehensive guidelines for KYC policy. A good KYC policy must follow the law and cover the four pillar clearly. What are the four pillar? First is customer acceptance, means who the bank will accept and who it will refuse. Second is customer identification, the CIP we just explained, monitoring of transaction, ongoing watch and alerting, and finally risk management, means how customer are assessed and treated based on the risk. So CIP start the relationship, transaction monitoring watches activity, risk management decide how strict to be, and the full KYC policy ties everything together. That is how bank keep your money and the system safe. Now friends, let's talk about the customization of the KYC policy. So not every bank is the same, so neither should every KYC policy be. I will explain how bank customize KYC to their business and geography. So first of all, KYC policy should match what the bank does and where it does. One size does not fit all. So there is something called business specific. A bank that mainly give retail home loan need different check than a bank that does large corporate trade finance. So location always matter. A bank operating only inside our country can skip rule meant for overseas operation. For example, a small cooperative bank with only domestic branches need not include rule about correspondent banking in the foreign country. Now there is something called global operation. If the bank has branches abroad, it must define country specific rule that follow local law and custom. So KYC step for a branch in country A may require extra ID document that country B does not ask for. Now then we have dealing with conflict between home law and the local law, right? So suppose sometimes overseas office cannot follow every rule from the home country. That is okay if it is handled properly, right? So document deviation, if any overseas branch cannot apply an Indian rule because its local law forbid it, the bank should note that clearly in the policy. The policy must explain what extra check or control the bank should use instead. These are compensatory safeguard, right? Now managing different approach across jurisdiction. So for bank active in many countries, the KYC policy should include tailored rule for each jurisdiction. Jurisdiction policy means maintain a simple local rule section for every country that the bank work in. KYC must cover other bank activity also, like selling mutual fund, insurance, third party product. For example, onboarding a customer for a mutual fund sale need similar identity check as opening an account. What about regulatory fit? Follows sector regulators rule when needed. For example, SEBI rule for investment, IRDA rule for insurance. So in short, write KYC to fit your business and place of work. Note when you can't follow home rule and add extra safeguard. And you should make country specific appendices, and don't forget to include para banking product and sector regulated fund. That is how the policies stay predicted. Now friends, do you know that KYC is not just for bank account, it must follow many rule book from securities to insurance. So regulatory compliance means the bank KYC rule must follow direction from other regulator also, not just the central bank. So who the regulator are? SEBI look after the investment product like mutual fund. IRDA look after insurance product, right? So what follow the rule means? So when I say follow the rule, it means suppose a bank sell mutual fund or insurance, it KYC must include the check SEBI or IRDA required. This makes sure that customers are protected and the bank does not break sector rules. Why this matter? Because following this rule prevent fines and protect the customer. It keeps the bank para banking services safe and legal. Now let's look at the role of the process manual. So the KYC policy tells what to do. Process manual tell how to do it every day. There is something called supportive to policy. Policy means the rules and the goals. Process manual means the practical instruction that staff follow to meet those roles. So what process manual include? Like a step-by-step procedure for onboarding a customer, exact document to collect, exact form to fill and where to fill them, how to run transaction check and what to do if something is suspicious. Everything is written in the policy document. Now, why process manual are so important? So process manual are so important because that they give operational clarity, right? They give you operational clarity and also they ensure uniform implementation, the same standard across all the branches. So suppose a bank employee sell a mutual fund, the process manual will tell them exactly which ID to collect, which SEBI form to use, how to record KYC and when to escalate for extra check. So in short, regulatory compliance makes your KYC fit each product rule. Friends, if you are looking for short notes, unit-wise MCQs, more than 2000 MCQs for practicing and previous year question, you can enroll in our AML KYC course You can get detail by WhatsApp me on this particular number, or in the description section you can check. Now friends, let's talk about the precision in the implementation of AML CFT through process manual. That is called step by step execution. So friends, want to know how bank makes sure that anti-money laundering rules are actually followed? So process manual turn policy into exact steps so that staff know what to do every single time. What this means, instead of following KYC rule, a manual say collect ID, scan and upload, run risk check, accept or escalate. Why it matters? Because precise step remove confusion and reduce mistake. So when a customer open an account, the tailor follow a checklist in the manual, no skipped step, no guesswork. Now, uniformity across principle. Manual must make sure that the same rule apply across all the whole bank, from the branch counter to the back office and the compliance team. So every document, every department use the same step and definition, so action are consistent and auditable. Then we have something called business line specific manual. So different product need different manual. So one size approach does not work here, right? Why? Because retail saving, corporate trade finance, mutual fund, insurance sale each have unique risk and document. So what to do? You should create separate SOP, that is called separate standard operating procedure for each product or business line. So right, so staff know exact step for that product. Right, that is called business line specific manual. End to end coverage. So manual must cover the full cycle from first meeting to the regular follow up, like onboarding, transaction monitoring, suspicious activity reporting, that is called SAR. You know what is SAR? How to investigate and record old activity to authority, that is called suspicious activity reporting. Onboarding means identity check, transaction monitoring means automated rules. Then we have periodic relationship review, so regular recheck based on customer risk. So why end to end matter? Because it gaps create vulnerability, so complete coverage closes them. So for example, a manual tell what to do when a transaction is flagged, who investigate, what evidence to collect, and while to file the report. So process manual are like practical playbook. They make AML CFT work in reality by giving precise step, ensuring consistent action across team, tailoring rule by product, and covering the entire customer life cycle. Now we have alternative structure in the process manual. So do bank use the same rule book for every product? No, they use focused manual and a clear customer acceptance policy. So process manual are not a one big clock. They are split and tailored so that staff get the exact guidance they need for each product. So there is section wise clarity. Manuals are divided into section for different business line, retail, corporate, investment, insurance, so that each team has a focused playbook. Then we have tailored design, which means each manual is built to match the product risk and step. We have something called CAP, customer acceptance policy. CAP is the bank first filter. It decides who the bank will accept as a customer and who it will not. There is something called risk mitigation. So basically CAP job is to reduce money laundering, terrorist financing, fraud risk by accepting only genuine customer. If you look at the foundation of KYC, CAP is the base of whole KYC process. It set onboarding boundaries and rule before deeper check begin. So friends, risk mitigation, I told you that CAP job is to reduce the money laundering, right? Money laundering, terrorist financing and fraud risk. What is the foundation of KYC? So CAP is the base of the whole KYC policy. It set onboarding boundaries and rule before deeper check begin. So what are the things included? So there is like a clear checklist. So clear criteria, who the bank will accept and who it will refuse. Credential verification means rule for background check to avoid onboarding doubtful or high risk people. Then we have some prohibited account practices. CAP also lists things that the bank will never do, like anonymous or fictitious account. Bank must not open or hold account in fake or unnamed identity, right? So why it matters? Because banning such practices, right, stop easy routes for criminal to hide or move illegal money. So to summarize, a split and tailored manual give precise action step by step for each product. CAP is the gate that accepts only genuine customer, and prohibiting anonymous account protect anyone. That everyone, right? So that is how bank keep process practical and safe. Now restriction on account opening. So friends, can a bank refuse to open an account for someone? Yes, and there are strict rules. So the very first rule is if the person identity can't be proved clearly, bank will not open an account. Suppose if someone give unclear information or can't produce the valid ID or proof, bank must refuse the account. For example, if someone has no document and claim to be Mr. X with no address, the bank will not onboard them. Then we have Benami account. This means the account that is opened in someone else's name while a different person really own or control it. For example, if person A uses person B name to hide that A is real owner, bank will refuse and report it. Then we have, bank do a strict check, verify ID document, confirm beneficial ownership, ensure that account is not linked to the hidden or undisclosed entity. So these are the points. Now there are some regulatory restriction. So basically, beyond identity, regulator maintain law and maintain list and law that block certain people or group from the opening account. Right, that is called regulatory restriction. Then we have RBI sanction list. If a name appear on the RBI sanction list, the bank must not open the account. Sanctions are used against people or entity tied to the crime or illegal activity. Then we have UAPA, Unlawful Activity Prevention Act. So entities or person listed on the UAPA are barred from having bank account. Then we'll discuss the FIU alert and RBI causes. So if the financial intelligence unit or RBI issue an alert or caution about a person or company, bank residing other country should not open them. Then we have other negative list. So bank can also refuse services to people appearing on other official regulatory list or internal negative list, right? Then what bank can do in practice: verification first, checklist, report. So we can summarize that: no clear ID, Benami name, or appearance on sanction terror alert list, the bank will refuse the account. And these rules protect the bank, customer, and the whole financial team. Now friends, let's talk about first of all additional accounting opening guideline. So bank are not allowed to open account for person or company that appear in the international sanction list, like those issued by USA, UK, or European Union. Bank are not allowed to open account. Second point is that second rule is that user identity of the identity verification issue. What it mean? That if a customer identity cannot be properly verified, maybe document are missing, fake, or the person not cooperating, then bank will not open the account. Third rule is the wider applicability. Means these restrictions are not limited to the saving or deposit account only. They apply to all types of banking relationship, loan, credit card, remittance service, right? And then we have the fourth rule, which is called review and exit policy. Okay, so the wider applicability is clear. Review and exit policy means suppose a bank already has an account with a person who later appear in this prohibitory category. Bank must review the account, right? So that is the point. Now documentation guidelines. Let's talk about it. So basically, we are going to understand some very important rule that bank follow before opening your account. So bank don't ask for the same document from everyone. It depends on the risk level of the customer. If you are a low risk customer, like a salaried person with a clear profile, fewer document may be required. But if you are a high risk customer, like suppose someone handling large international transaction, bank will ask for more proof. This is called risk based due diligence, right? Secondly, bank must follow the laws and regulation. So some document are mandatory, right? So if you are a low risk customer, and then in that case fewer document will be required. That is called risk based due diligence. Secondly, bank must follow the laws and regulation, right? So if some documents are mandatory like Aadhaar, PAN, proof of address, bank also check the authenticity, which means whether documents are genuine or fake. If a person is operating account on the behalf of someone else, then the bank need document proving the authority to act. Then we have customer risk categorization. Customer are grouped into low, medium, or high risk category. The risk is about money laundering and terrorist financing chances. So how it is decided? It is decided based on your profile. Means individual, company, trust, etc. It is decided based on your business type, like simple, salaried, or cash heavy business. It is decided based on your source of fund, geography, transaction behavior, right? So what are the parameters used for risk determination? So bank use clear, transparent rule for deciding the risk. For example, a person with a regular salary and total transaction, lower risk. A person with frequent larger international transfer, higher risk. Now approval authority guideline. It says that if the customer is higher risk or case is complex, normal staff cannot approve. Approval must come from senior management, not just for opening account but also for any other business dealing. This adds extra safety and control. Now friends, let's look at the parameter for risk determination. So what are the parameters for risk determination? Let's have a look at it. So you should define the transaction parameter. Yes, PMLA reporting requirement. So what does it mean? That basically there's something called STR, right? Suspicious transaction report. So bank has to report any transaction. As you can see, these are the reports. Bank have to report any transaction that looks suspicious. It could be cash, online transfer, security, or anything. The important part is that there is no minimum limit. Even a small transaction, if it looks suspicious, must be reported. For example, if someone keeps splitting 9.5 lakh deposit again and again just to avoid the 10 lakh cash limit, that is suspicious. So as per the rule, bank must fail the STR within 7 days, right? So this is the rule regarding the STR. I told you na, any kind of suspicious transaction that has to be reported. What is CCR? CCR is called counterfeit currency report. Let me show you CCR. Yes, here you can see. So suppose if the bank find fake currency in fake currency note in any cash transaction, they have to report it. Not just fake note, having forged securities or fake document used in the transaction next month must be reported. Right? Frequency should be bank must send this report every month, and deadline by the 15th of the next month. Right? Then we have NTR, non-profit organization transaction report. So if any charitable trust or NGO receive 10 lakh or more, bank has to report it. This apply whether the money is in rupee or in foreign currency equivalent. Frequency is monthly and timeline is 50. Talk about the regulatory obligation. So reporting violation under Rule 8 subsection 4. Suppose a bank delay lending report. Each day of delay count as a separate violation. This means penalty can get very heavy. And there is internal mechanism. Bank must keep a strong internal reporting system. If their system is weak, FIUIND can take regulatory action against them. So let's quickly revise the key point which we have just discussed. We started with STR, which is called suspicious transaction report. Suspicious, no limit is there. Report within 7 days. CCR, counterfeit currency report. So here you have to report the fake note on currency. It has to be done monthly within 15 days. Then NTR is called non-profit organization transaction report. Right, so here here NGO NPO, right, reporting. So here 10 lakh plus means NGO where mandatory for cases where NPO receive 10 lakh or more, right, that has to be reported in NTR, and monthly it has to be reported and submit by the 15th of the following month. Then I told you each violation, each day delay, there is separate penalty for that, and internal mechanism, a strong reporting system is required. Now let's talk about STR guidelines. So STR is called suspicious transaction report, right? So if a transaction look odd or if a transaction look possibly criminal, the bank must report it. Bank must report it no matter how big or how small, right? That must be reported by the bank. So what to watch for in such case is strange pattern, sudden large transfer, unusual behavior, or attempt to hide the real source of money. These things to watch for. So key rule is that no threshold means any suspicious activity must be reported, right? So there is no threshold, any suspicious activity must be reported. This is the very important point. And deadline is that you have to file the STR within 7 days, right, of identifying the suspicion, right? For example, if a customer who normally get a salary suddenly start receiving many small cash deposit, then that move overseas, flag it and file it STR. Then CCR, that is called counterfeit currency report. So if a fake currency or false paper are involved in the cash deal, bank report it. So it includes fake notes, forged signature, forged security, or fraudulent document used in the transaction. So the frequency is monthly, right? CCR frequency is monthly, and deadline by the 15th of every month of the next month. Suppose if a tailor find the fake note during cash deposit, that goes into the monthly CCR. Then we have NTR, non-profit organization transaction report. So when an NPO receive 10 lakh or more, right, the bank must report it. Frequency is monthly. So you should submit by the 15th of the following month. For example, if a charity get a 12 lakh donation in a month, the bank file an NTR for that month, right? Now friends, reporting obligations and penalties. So I told you that what is the daily delay rule in the previous slide I have just discussed. Now STR, when to file STR. I told you when to file an STR. So STR you have to file whenever there is a reasonable suspicion that money is linked to a crime, no matter how small or how large the amount. Then you have abandoned and aborted transaction. Suppose if a customer start a transaction but abandon or cancel it in a way that look odd, that must also be reported as an STR, even if no money finally moved. For example, someone tried to deposit cash, then abruptly asked to reverse it with a strange reason. Flag and report it. Record the reason, which means the principal officer, which means he is the senior person responsible for STR. He must write down in plain word why they think the transaction is suspicious. Why a written note create an audit trail. It explains the bank decision letter if needed. Now act quickly, which means branch report must be reviewed fast. Don't sit on them. Timely action prevent evidence from disappearing. Now generate alert using guidance. Generate alert, which means use a standard list and indicator like IBA guidance note to trigger alert. These give common red flag to watch for. Use technology to help. So deploy monitoring software. It watches pattern across account and help spot risk human might miss. Then keep STR confidential, which means STR must stay secret. Do not tip off the customer or anyone connected to them, because telling the customer can destroy evidence or let criminal run away. And don't restrict account just because of an STR. Filing an STR does not automatically mean freeze or close the account. Banks should avoid restricting services unless an authority directs it. So these are the key points. Now let's talk about the CCR, which is called counterfeit currency report. You know that CCR is sent when a bank finds counterfeit currency or related forgery in a transaction. So when to report CCR, that any case dealing where fake note are detected, case involve forged signature, forged security. So the report can be submitted to FIU IND using the prescribed format. FIU accept electronic submission and batch upload. Plain text or fixed with text file are also supported where specified in the reporting guidelines. So CCR are compiled as per the FIU reported schedule and the bank internal process. Then we have NTR, non-profit organization transaction report. So NTR is for transaction involving charities and non-profit. Suppose if an NPO received 10 lakh or more for foreign currency equivalent in a month, bank must report it. Now question is which NPO, right? So registered trust societies under the Society Registration Act 1860 and Section 8 companies, right? So frequency and deadline, if we talk about, these reports are normally monthly and must be submitted by the 15th day of the following month, right? If you look at the nature of FIU IND report, so bank must monitor transaction constantly and file different report type, right? It should file different report type to FIU IND. Some are rule based and other are suspicion based. If you look at the rule based report, CTR, NTR, CVTR, CCR, they are mainly rule based. They are triggered when transaction cross defined threshold or meet a specific condition. Now we have some suspicion based report also like STR, right? So STR are filed whenever there is a reasonable suspicion regardless of value and follow timeliness and requirement. Now the question is how report are prepared and submitted. Let's have a look. So basically the bank technology decide where reports are made. Bank with CBS, some bank with CBS. So reports are typically generated centrally at the data center and submitted in batches. And bank without CPS, branch prepare report locally. The head office consolidate them before sending to FIU IND, right? So quick recap, CCR is for fake cash currency report, use FIU format. NTR charity received more than or equal to 10 lakh monthly by 15th. Many report are rule based while STR are suspicion based, and report may be system generated CBS or branch prepared and consolidated, right? That is the point. Now if you talk about the nature of FIU IND report, so I told you report type may be rule based and norm based. So rule based report includes CTR, NTR, CVTR. Threshold is 10 lakh plus. CCR for counterfeit and fraud forged documents. CBS bank central generation, non-CBS bank branch and then sent to HO head office. CCR sent to HO, not RBI report. What about one more thing, that CCR must be sent to head office separately from RBI report, right? Now norms based. So STR relies on the banker judgment of genuineness. Filed defectivity is suspicious and non bona fide. Utility of this report is that CTR, NTR, CVTR, right? They provide extensive transaction data, though they may include many genuine transactions. If we talk about STR is very it is key for unusual and risky cases, right? If we talk about combined approach, so rule based report support STR by giving background detail, while STR highlight real risk case, right? If we talk about the responsibility, so STR needs close monitoring plus due diligence. Now let's talk about the CTR. So friends, that CTR is filed whenever a customer cash transaction in a calendar go beyond. That is called cash transaction report. CCR is different, cash CTR is different. Whenever a customer cash transaction in a calendar month goes above 10 lakh, then CTR is filed. So it must be only in cash. The cash transaction must be of the same nature, all credit or all debit. Same calendar month, which means aggregate all qualifying transaction in the same month. Aggregated value should be exceed the 10 lakh. If total crosses 10 lakh, file a CTR. Suppose Mr. A deposits 6 lakh on 5th, 5 lakh on 20th, both cash credit. Add them, it will be 11 lakh, so CTR is required. So if one single cash transaction itself is more than 10 lakh, then all other cash transaction of that customer. NTR stands for non-profit organization transaction report. So NTR are for charities and NPO. So these are the report when receipt in NPO account reach 10 lakh or more in a month. Now who is an NPO? See, registered trust society under Society Registration Act and Section 8 company under the Companies Act, they are called NPO. So what bank must do? So bank ensure that account are clearly categorized as NPO account. And if an NPO account receive 10 lakh, try to understand. Suppose an NPO account receive 10 lakh, right? Basically for foreign currency equivalent or more in a month, you should file an NTR. What is the FCRA note? So FCRA note says that foreign contribution to NPO are allowed only with MHA, Ministry of Housing and Affairs approval, right? Such foreign inflow must be credited to the specific account named in the approval and monitored as per the rule. Now, so there is something called CBTR. This is called cross-border wire transfer report. So CBTR cover all cross-border transfer above 5 lakh rupees. So threshold is 5 lakh. It apply to all the purposes: import, export, loan, investment, remittance, etc. Any cross-border flow above this limit must be captured and reported as per the bank procedure. So friends, CTR means cash total over 10 lakh in a month. NTR means NPO received 10 lakh plus in a month. CBTR means cross-border transfer above 5 lakh. So remember this threshold, very important. CBTR 5 lakh. Bank must monitor, aggregate correctly across account and file report as per the rule. So friends, this is the very important thing. CTR, remember, more than 10 lakh. Example of CTR I have given you. Transaction less than 50,000 not reported individually but counted in monthly total. NTR I told you. NTR is NPO received greater than or equal to 10 lakh. FCRA point I told you that foreign donation need MHA approval and must go into the approved account. Now friends, let's talk about the CCR. So CCR, what to report in CCR? Any cash transaction where counterfeit notes are found or where forged securities and documents are used. How often it is reported? See, it is reported monthly to FIU-IND, right? And then also inform. In this case, police and RBI are also to be informed as required with proper reconciliation of the account. If you look at the format, so FIU accept plain text technical format, a simple clear report is acceptable. So if you look at the practical action, what staff should do? So isolate the suspicious note, record serial detail and transaction fact, notify branch compliance, prepare CCR for monthly submission, etc. What about STR? So STR are the most important tool for spotting money laundering and terrorist financing. So why STR matter? Because they point investigator to unusual activity that rule-based report might miss. And no amount limit is there. STR are filed regardless of the transaction size, be it small, be it large. If it looks suspicious, report it. Then what is the role of the bank and resources? So filing STR need good monitoring system, trained staff, analyst review. It is resource intensive but essential. If you look about the timing, so we can see timing of STR. So basically file an STR promptly, right? For example, within 7 days from identification. Confidentiality are there, so STR are secret. Do not tip off the customer. Now let's look at some definition under PML rule. Transaction. Transaction is a very broad purchase, sale, loan, pledge, gift, transfer, delivery or any arrangement that moves the value. It covers non-obvious action like safe deposit, locker dealing, fiduciary relationship, forming company or payment against obligation. Now friends, if you look at the suspicious transaction, what it means, a suspicious transaction is any transaction that by indicator or behavior suggests possible money laundering or terrorist financing. These indicator, they form the basics to file the STR. So to summarize, CCR means report counterfeit currency forgery monthly, and STR you report anything that is suspicious, no matter the amount, using a strong monitoring and immediate action. So to recap, we can say that CCR, CCR means report counterfeit note and forgery monthly. Then we talk about STR, right? So STR rule 2G. So what it says that, so basically STR apply to all kinds of transaction under the PML rule, be it cash or be it non-cash, and even to the transaction that were started but not completed. For example, bank transfer, check payment, securities deal, loan, guarantee, locker dealing, and sale on creation of entity. Right. So what is when is a transaction suspicious? These are the cases. First of all, you file an STR when the transaction involves proceed of a crime. Second, if when a transaction is unusually complex or does not make economic sense. Third, when the transaction has no genuine or bona fide purpose, means the activity looks fake or only cosmetic. Fourth, when the transaction raises suspicion of terrorist financing. For example, large round figure transfer between unrelated account with no business reason. Fund from a high risk country arrive with no clear source. So these are the cases. Now if you look at the key features of STR, so suspicion is the only test, which means amount, mode or channel does not matter. You must assess the intention behind the transaction, and it should be guided by the red flag indicator. Now STR includes non-fund services also, like guarantee, para banking product, third party sale. Any odd customer behavior, any unusual questions like avoiding KYC, being evasive can be a trigger, right? So these are the things. So basically now let's talk about the transaction monitoring. You know that keeping an eye on the transaction is how bank stop bad money from moving, right? So transaction monitoring is a continuous watch on customer activity so that bank can prevent money laundering and terrorist financing. So you should match transaction to the customer profile. Check that what a customer does makes sense for who they are. For example, a school teacher account does not suddenly show regular multi-crore imports. Similarly, enable timely reporting to FIUIND, which means spot suspicious activity early so that report like STR can be filed on time. Now, what is the norms for effective reporting? So, monitoring must be risk based. Focus more where the danger is. So, there is something called risk based approach. So, high risk customer get more attention. Politically exposed person, right? So these are the high risk customer, right? Complex corporate structure, cash heavy business. These are high risk customer. High risk product and services like import, foreign investment, large trade finance. They need enhanced check. So why resources are limited. So you should concentrate on the most likely threat. What about the unusual transaction? So unusual transactions are the red flag. So they deal with the no economic reason. They are large or complex transaction. The transaction near or beyond the threshold limit, right? Cash flow activities which are inconsistent with the customer normal pattern. So these are called unusual transaction to watch. Now if you look at the monitoring modalities, means how bank actually do it. So bank use system and human check together. So there are simple process. For first of all, exception report analysis. So the core banking solution or CBS or monitoring software run rules and flag exceptions, unusual amount, frequency, pattern. So these are the alert analyst review. Then they compare with the compare with software utilization. So the first question is why monitoring is so hard. It is not easy. Bank have a huge customer base, many different product, and criminal get smarter every year. So lots of transaction, right? Millions of move a day. Pattern hide in noise. Then many products and services are there like saving, loan, trade finance, investment product, and each one has different risk. Then we have sophisticated laundering methods. Criminal design complex flow to hide the origin of money. And straight through processing, in short we call it STP. What happen, when system process transaction automatically with minimal human check, unusual activity can slip through unless rules are right. So the second question is how AML software help. So good AML software is like a super watchful assistant. It looks at everything, it links data, it raises warning, right? So first of all, full coverage. It monitor all the transaction across accounts and products. Rule based check. It use preset rule like threshold, pattern to detect any suspicious behavior. Link analysis. It connect different account. It connect different transaction that belong to the same person or group. For example, if money comes in one account, it moves quickly through several accounts, then exits. So software link those move and raises an alert. There is something called TMBL or trade based money laundering. Why trade is risky? Because global trade moves huge sum and uses many documents that make it a favorite route for laundering money. So money arrives from abroad and is immediately taken out in cash. Then if we talk about the high risk business category, so business known for cash or complex trade, they need closer watch. Now, account open briefly for advances. Account that exist only long enough to receive an advance remittance and then close. Then we have some irregular or unusually large advance payment. So very large prepayment with little business rationally. Intangible or hard to value goods. There are transactions for services, royalties, software where pricing is vague. Then we have high seas sales or unusual shipment terms. Lot of high seas sales or inconsistent shipping that don't match the document. Then we have fund transfer via exchange house despite existing bank account. So we are using money exchanger instead of banking channel. It can be a big red flag. Vague good description or inconsistent trade document. Invoices saying miscellaneous or bills that don't match packing list. Import payments against very odd bill. Paying old invoices without clean reason. Then missing detail in the wire transfer. No beneficiary address, purpose or invoice reference. Frequent unjustified LC amendment. Constantly changing letter of credit to obscure the real transaction. Right. So now let's look at the board responsibility. So board responsibility is to ensure that KYC policy complies with all the legal and regulatory norms. Board responsibility to approve and implement CAP. What is CAP? Customer Acceptance Policy. To establish effective AML CFT processes. Now what is the senior management responsibility? Yes, one more thing is that board responsibility is to appoint a designated director as mandated under PMLA. Board conduct periodic review of KYC AML CFT compliance. Now if we talk about the senior management responsibility to ensure end-to-end compliance with KYC AML regulation, to share accountability for legal and regulatory adherence. This question is asked, what is the designated director responsibility? What is board responsibility? So you should know the difference. Like you saw DD responsibility, overall PMLA compliance, to monitor the KYC policy, right? To monitor the KYC, appoint a principal officer, ensure timely submission of FIU IND report, ensure adherence to KYC in sales and marketing operation, maintain accurate KYC AML record. So these are responsibility of DD. DD means designated director, right? Please, I request you, please go through this, very important from examination point of view, right? So tell me, who ensure timely submission of FIU IND report? So the answer is DD, designated director. Who appoint principal officer? Answer is DD, designated director. Who maintain accurate KYC AML? Answer is designated director, right? What about principal officer? So principal officer, they oversees operational implementation of the AML KYC guideline, right? So they coordinate with units for KYC AML operation manual, risk assessment in product paper, model for customer risk categorization. So these things are overseen or monitored by the principal officer. File mandated report with FIU IND within timeline. Now what are the key responsibility of PO? First of all, proper arrangement for FIU IND report submission. Second is use red flag indicator to detect suspicious activity. Organize KYC AML staff training program. Submit periodic compliance report to board or audit committee. So please understand the difference between the DD responsibility and the PO responsibility. Who appoint PO? DD appoint PO. Just now I have told you, right? The appointment of the PO lies with the DD. DD means what? Designated director, right? So remember these key points. So now let's move forward and let's look at the AML monitoring units. This question may ask you that what is the responsibility of the senior management? So you must answer that senior management, if we talk about, just let me remind you, senior management are executor of the board policy. They ensure 100% compliance with KYC AML rule across department. They share accountability if the rules are broken. Then DD responsibility, I told you, overall compliance with PMLA. Make sure that all the bank products and processes are in line with the KYC rule. Appointing a PO, ensure timely reporting to FIU IND, right? These points. PO responsibility, I have told you, is like operational commander. They file mandatory report with FIU IND on time. They oversees the daily implementation of the KYC AML guideline, right? So they work with the operation manual, risk assessment in product paper, SOP. What is SOP? A standard operating procedure for monitoring transaction. customer due diligence procedure, model for customer risk categorization. So board make policy, board approve CAP, board review compliance, board appoint designated director. Remember, I am telling you this is the very important thing. So who appoint designated director? Answer is board appoint designated director. Senior management ensure execution and full compliance. Designated director is the big boss for PMLA compliance. They appoint PO, they ensure reporting, they ensure monitoring. We are talking about DD, designated director. Designated director ensure training. Principal officer handle day-to-day reporting, transaction monitoring, due diligence, risk categorization. All these are handled by the principal officer. So remember the difference between the role of senior management, designated director and the principal officer. So friends, that was a breakdown of the role under KYC AML compliance. Now friends, if we talk about the principal officer, so I told you the key responsibility of PO, right? So PO is the bank operational head for AML. He make FIU IND report, right? Principal officer, what it do? They make FIU IND report happen on time. They ensure system and people submit STR, CTR, CCR, NTR, CBTR as required. They also confirm that every reportable transaction get captured in the bank report. They use some red flag indicators, right? So they rely on suspicious indicator to spot the odd transaction. They run regular KYC AML training so that staff know red flag and procedure. They inform the DD, that is designated director, about regulatory changes or legal update, right? They report upward. They submit periodical compliance report to the board or audit committee showing how well rules are followed. Then we have AML monitoring units. So what they do, these are unit, the AML unit are the specialist team that watch transaction, that analyze alert, that manage STR. So what they do, they monitor transaction, they review the alerts. So they analyze suspicious pattern. AML monitoring unit analyze suspicious pattern and prepare STR recommendation. They handle CTR, NTR, CCR, CBTR workflow as assigned. And if you look at the size and structure of the AML monitoring unit, they depends on the bank size, product mix, number of branches. They can be centralized, which means one team for the whole bank, or they can be separate unit per region or per product. Now if you look at the reporting line, so you can see that functionally you have to, basically we are talking about AML monitoring unit. So functionally they have to report to the principal officer that keep independence and clear accountability. Now if we talk about non-STR report submission, so not all report are STR. Several are rule based and they are submitted monthly. So what are the monthly rule based report like CTR and NTR? So they are account based report. CTR for cash threshold, NTR for NPO receipt. What about CCR? CCR stands for counterfeit currency report. It may be handled by AML unit or a force node vigilance cell at the head office. Then we have CBTR. CBTR stands for cross border wire transfer. So AML unit usually monitor and file these. So remember, what is the responsibility? So CTR and NTR are the account based report. CCR is the counterfeit currency report and CBTR is the cross border wire transfer. AML unit usually monitor and file this, right? Now if you look at the STR submission, so they are alert based. STR are not automatic. They follow a multi-stage process from alert to the final filing. As you can see, the process flow is like this. First of all, monitoring software generate alert using red flag rules. Then AML unit analyst review alert, right? So basically this is a kind of team effort. Technical analyst plus PO, both of them combined together, and every step must be recorded. So first of all, monitoring software is there which generate alert using red flag rule. AML unit analyst, they review alert across all products. Then in-depth analysis is done and validation is done. Then recommendation is done. Analyst prepare STR recommendation with written reason, and then it is reviewed by the principal office. Principal office or PO review it, right? And finally STR is filed confidently. So friends, principal officer keep all the reporting engine running. AML unit do the heavy lifting of the monitoring and the analysis, rule based report and file monthly, and STR follow a careful alert, analyze, approve, file cycle, right? So that is a careful alert cycle. So that structure keep bank compliant and the financial system safer. Now friends, let's look at the review of the red flag indicators. Yes, let's have the review of the red flag indicators. So if you look at the AML red flag reviews and duties, so red flag indicators, they are regulated, they are regularly updated by the AML unit. Remember, red flag indicator, or we call it RFI, they are regularly updated by the AML unit. This reduce false positive. Then we have something called whitelisting. What is whitelisting? So whitelisting avoid repetitive alerts. It focus on genuine suspicious case. Then we have STR initiation. So if you look at the branches or unit, so you should report suspicious cases. And if you look at the AML unit, they should review, they should decide STR filing. Now there is something called transaction processing unit. So what is the duty of this transaction processing unit? They verify KYC document during transaction. For cross border, they check all the document. They detect any discrepancies or any unusual feature. They alert the AML unit immediately if anything found suspicious. They ensure customer risk categorization at account opening. Now if you look at the branch and field unit, to perform the CDD, to perform the KYC at onboarding. There is a continuous monitoring of account and transaction, right? The branch and field unit stay alert to behavior and the market intelligence, and they report unusual or suspicious activity to the AML unit, right? So these are the points regarding the branch and field unit. So friends, we are talking about the branch and field unit responsibilities. They perform CDD. What is CDD? It's customer due diligence. Means taking all the documents of the customer in the right way, and the right way to collect them and verify them, right? And then they also monitor the account and transaction continuously. Third point, they stay vigilant, right? Always vigilant about the customer behavior and the market intelligence. They report unusual or suspicious activity promptly to the AML unit. Remember, these are the points, right? Now friends, let's talk about the compliance function. So ensure regular updation of KYC policy as per the regulation. Audit function there are. Now let's talk about the interlinking of the money laundering and the terrorist financing. Very, very important. Though ML and TF are distinct, but they are closely connected in today's financial ecosystem. Corporate or NGO structure often act as a cover for the both. Benami transaction allow crime money to be funded into legitimate business. Terror outfit uses social commercial activity to channel illicit fund disguised as donation or investment. What are the risk management? So just to recapitulate, branch and field unit, CDD, monitoring, reporting, alert investigation, compliance, KYC policy update, guidance documents, and document guidance and new product vetting. And audit is the annual audit, compliance verification and risk mitigation. Right, very, very important. So I told you now, ML and TF are interlinked. They are distinct but closely connected in finance. Corporate and NGO use it as cover. Benami transaction, basic risk mitigation measure. First is CDD. CDD means customer due diligence. So in this case, you identify the genuineness. It reduces the ML and TF risk. And accurate KYC plus periodic review, it ensures better monitoring. Ongoing monitoring for early detection and reporting to FIUIND. If you talk about the financial intelligence, so they share intel, link person, entities, suspicious flow, and there is something called international FIU cooperation, cross-border detection. Now friends, if you look at the impact of the financial crime, so you can see if financial crime causes heavy loss and erode trust. For example, plantation scheme 1990, golden forest, fake promises, post-dated check. Now friends, let's look at the fraudulent schemes and the risk. Have you heard the name of Susi EMU farm? So basically what happened, in the year 2006, buyback collapsed and investor get stranded. Then we have the EMU scheme. So it caused face marketability claim and ultimately it leads to failure. PACL and SPKCA, it causes large scam and SEBI refund ordered. RBI warning, RBI warned bank to monitor MLM and unauthorized scheme because there is a risk of liability. If you look at the KYC AML compliance challenges, the first is that it is very essential. This compliance is very essential for money laundering and terror financing risk management. Customer inconvenience, right? But often causes customer inconvenience due to repeated documentation. And there are different regulators, different KYC rule are there, which create compliance burden. If you talk about CKRC, that is called Central KYC Record Registry. So it was established. PML rule was amended. CERSAI designated as CKRC. What are the functions of CKRC? So to receive, to store, to safeguard eKYC, enable online retrieval like RE, FIUIND. And if we talk about the submission, so RE, right, RE, they eKYC within 3 days of relationship start. So what I'm telling you that RE or reporting entity, they must send electronic KYC copy within 3 days of starting a customer relationship. And if we talk about the physical record, so reporting entity must also keep the hard copy. If we talk about the KYC identifier, that is unique code. CKRC assign unique code per client, and the reporting entity must communicate code in writing to the customer. It enables online retrieval across all the reporting entity. There are some additional guidelines like reporting entity may still ask for update auto shared with all the RE links. Last RE verified, the last RE verifying KYC is responsible for authenticating the client identity. And CKRC data only used for KYC verification. Third party use required authorization. If you talk about the benefit of central KYC registry, single KYC submission, which means customer avoid repeating KYC with multiple entities. One time update, which means only one time you have to submit the KYC and it will be valid for all the institutions. And if you change your detail, right, suppose your Aadhaar get changed, phone number get changed, then you have to only one time update CKRC, and this will automatically reflect system wide, right? Every resource gets saved, duplication get avoided, and it become easier for financial institutions. That's called resource saving. And this system ensure uniformity, means customer data everywhere remain consistent, right? And one more benefit of CKRC is central deduplication, which means suppose a single person has opened different accounts with different names, right? So system can easily detect it. That is called deduplication. So basically CKRC is a unified customer identification code, that is called UCIC, right? What is UCIC? UCIC is it is an identification code, unified customer identification code. Full form is unified customer identification code issued by CKRC, which provide financial system standardized norms. So that standardized norms is followed in our financial system, right? RBI and SEBI has already allowed FII, right? FII should regularly, right? So CKRC, is a single KYC, one-time update, uniformity, duplication avoided, central deduplication. It supports UCIC for entire financial system. Now that's what I told you. UCIC, Unified Customer Identification Code. RBI and SEBI enable joint use of KYC record for FII. Right. Now friends, let's look at the organization-wide role in the KYC AML. So does KYC and AML work only in the compliance team? No, it is everyone's job. Right. So KYC AML is not a paperwork task. It is an organization-wide duty. Every employee help the bank meet legal obligation, that is called PMLA obligation. Senior management and the board must treat it seriously. Both the bank and the individual can face penalty for failure. Now the question is, why staff training and awareness matter? So training turn policy into action. Without training, even good rule fail in practice. So you should know the red flag. Right, you should know the red flag, which means a staff should recognize suspicious behavior or transaction. Then you should understand the procedure. Everyone must know how to report suspicious and where to send the queries. Regular refresher, which means short frequent training, keep people current, not one big course once a year. That is called regular refresher should be done. Now communication work this way. So the first way is is called manual or SOP. So manual and standard operating procedure spell out exactly what to do. They include step-by-step KYC AML task, AML risk category, who is responsible. So keep them updated and use them as a proof of compliance during inspection. Regular circular. So circular are short notes sent to staff when rule or processes change. So use circular to share urgent RBI or regulator update or internal directive. Then we have the guidance note. So guidance note and FAQs explain why the rule exists and answer common what if question. Right, so these are the important points. So KYC AML is every employee duty. Board and senior management must on compliance. Individual can face penalty. Continuous update is required. Regulation changes frequently. That's why I told you that manual SOP, these are the formal step-by-step guidance. They give you evidence for inspection. Regular circular, this is the fast way to share urgent regulatory or any internal challenge. Now if you talk about the awareness tool, right? So basically FAQs, that is called, frequently asked question. So in formal medium to explain rationally and purpose of the KYC AML. Then you have EDM or flyer, right? So basically these are the, these are the small and impactful message which grab the attention, and they highlight the critical compliance point. What is important about staff training? That skill development is required. It is covered across all the level. It is tailored for board member, senior management, compliance team, frontline staff, etc. There is something called, differentiated program, right? So at every level there is a different focus. Like front line of staff focus on onboarding, compliance staff emphasis on reporting, regulatory update and risk evaluation. And then we have sales and operation staff, they ensure customer risk awareness and transaction check. Then we have something called ongoing training. So there is something called induction training for new recruit, continuous update for new ML and TF method, right? And refresher training. What about the board and senior management responsibility? They ensure PMLA and RBI guideline. They approve and oversees the KYC policy. They identify any high risk business line. They ensure compliance culture bank wide. Then we talk about the DD and senior management role. I told you, directly responsible for PMLA compliance, assess and mitigate ML and TF risk, formulate and implement AML and CFT strategy, address IT need for monitoring and reporting, align organization structure with AML monitoring, ensure policies and plan reflect ML and TF risk. These are the important parts. Now friends, when we talk about the head staff of the processing and operating unit. So who watches the day-to-day check that keep dirty money out of the bank? Let's say you are the frontline executors. You must apply the customer due diligence every time. So do CDD for every customer. Say collect ID, address proof, beneficial owner information, and record the customer purpose for the account. Say if a customer is PEP, politically exposed person, a cash heavy business, or from a high risk country, treat them as higher risk, right? So these are the very important point. Then if we talk about the regional office and functional unit, so you turn policy into action across a region. So you make sure that branches follow the rule and classify the risk correctly, right? So translate the bank KYC rule into bank branch checklist and training reminder, right? Decide which customer, which product, which branches are low, medium or high risk, and set monitoring frequency accordingly. Train team to spot sale company pattern, rapid in-out transfer or unusual trade document. So these are the steps that needs to be taken, right? So friends, that is the role of, I think this is not that much important. You can just go through this paragraph. I again request you, if you want such kind of PDF, you can WhatsApp me on the number shown on the screen to get the PDF, to get access to highly quality content for AML KYC upcoming examination. So that is all we need to remember it. Just remember CTR, CCR, which we have covered. These are the super important. Thank you.